Hi, David here, CEO and founder of the Freedom Founders Mastermind. There's an article out in Monday's Wall Street Journal, Monday, May 20th. And the article was about the Starwood Real Estate Investment Trust Fund. Starwood, a big hedge fund, started by Barry Sternlicht, the founder. And Starwood's been a big player in the real estate markets, commercial markets, like Blackstone. They raise big tranches of capital and invest it into typically commercial real estate. Could be multifamily, could be even single family portfolios. Nonetheless, they put it in real estate and create returns for their investors. And that's a real estate investment trust are a way for people who don't want to be active, they want to be passive, to have a piece of the real estate piece, the alternative investments that everybody loves. And these funds are in the equity game. Equity is what everybody loves when the markets are going up. Equity is ownership, or you have ownership shares. You get tax benefits, tax preferences. You get the growth, the value add of an up market. You can use leverage, and these funds use leverage as well. So these are all the benefits that real estate provides in a, quote, normal market. And that's why we love real estate. The problem is the market doesn't stay strong, doesn't stay in a bull run forever. They always correct, they always change. This particular fund, Starwood's Real Estate Investment Trust Fund, was started in 2018. It became a $10 billion fund. That's 10 billion with a B. Large fund. And while interest rates were low and property values were going up, commercial, residential, this fund could return some nice returns to the investors who back then in 2018, 19, 20, 21, even into 2022, the rate of risk-off assets, meaning CDs, could be treasuries, municipal bonds, money markets, we're all paying way less than 1%. So a fund like Starwood, if they can invest it in other assets, which is what these funds are supposed to do, typically can get a better return than people just putting their money in savings. And with inflation running hot, people have got to get a higher return. That's why people put more money in the stock market than they should. That's why people who are retirees and should be on a conservative basis in their life, putting money in CDs and savings accounts, in treasuries, have to reach for the stars sometimes and go for what we know is to be riskier assets and riskier funds. Well, no negativity to Starwood or Barry Sternlicht, but these market cycles always run like this. And when you're over leveraged and you've relied on what we call cheap money, the interest rates that were so low coming out of the 2008 great financial crisis, those rates were just kept near zero for many, many years until we hit COVID and the pandemic. And then, of course, assets went up again and there's lots of money. And so these funds even took more money in, more money. 2018, 19, 20, 21, 22. I think at one point, this particular fund was taking in $600 million a month for a period of time a couple of years ago. Now, that's not the way it is today. What happened? They're only taking in about $15 million a month in new funds. They're out of money. Liquidity problems. Well, what happens? These funds typically offer their investors the ability to redeem their money out kind of when they want to. I mean, you put $100,000 in and you leave it there maybe for a year, 2 years, 3 years. And then if you want to move it somewhere, you've got better use for it. There's a redemption opportunity. Every fund, well, I say most funds that are evergreen, meaning the money goes cycling all the time, have the opportunity to redeem. That's something that sounds great, right? If I can put my money in to an investment that's returning a nice rate of return, and if I can get it back out pretty much when I want it, who wouldn't want that? Almost like going to the bank, right? But the banks don't give you those higher returns. The problem is, well, kind of like a bank, if everybody who had deposits or CDs that were short term at a bank went on the same day and said, I'd like to take my money out. If everybody who was a depositor did that, the bank couldn't provide. It's not there. It's the fractional banking system. They only keep a small amount on hand because in normal environments, not everybody wants their money out. They want to keep it in the bank or keep it in a savings account or money market. Liquidity. It's about liquidity. Well, these funds also maintain a certain amount of liquidity, but they've got to get the rest of the money invested, right? I mean, the idea is to put money into assets, manage those assets, and get a return. So as long as people are putting money into the fund and on a regular basis, some people, a small percentage, want their money out, liquidity in the fund stays fine. All right, what's happened since 2018? Well, particularly starting in late 2021, 2022, Federal Reserve has to fight inflation, right, for the first time in 40 years. And so the Federal Reserve raises interest rates from 0 to over 5%, 500 basis points, 500% in a relatively short period of time. That's massive to those who use leverage financing in their business or their investment platforms. It's a massive change. And now, because investors can get 5.25%, 5.5% on a money market account or in U.S. Treasuries, why would they leave money in a fund like Starwood unless that fund can really deliver a much, much higher return? The risk premium is not there, is what I'm saying. Again, this is not just Starwood. I'm just giving you an example that was in the Wall Street Journal. This is happening across the board in many assets, not just real estate. I mean, corporations, the higher cost of capital and the higher cost of just everything, inflation, cost of living that's gone up, is cutting margins. And now the investors who were flush with money just a few years ago because of COVID, PPP loans, helicopter money everywhere, that money has dwindled out. The cost has gone up for everybody. So a lot of liquidity in the marketplace just a few years ago. These funds taking it all in. It feels good. They're making tons of money. Everybody's happy. But now the chickens have come home to roost, so to speak. And this is what happens in a market cycle. Why am I giving this to you? Because many of you are relatively novice in your investing path. That's okay. You work hard in other fields. Understanding the markets and studying those really hard is not something you have time to do. It's normal. And we all tend to, through behavioral economics and behavioral investing, tend to want to jump on board when the train is running hot. And many people jump on too late, not realizing that they're at the top of a market. And when that happens, then usually that's when things go awry. You put your money in late to anything that's kind of speculative, and some of these assets are speculative. They've been driven up so much. Even crypto is speculative, even though a lot of people love it. It's speculative. You don't know where it's going to go. It can be hot and cold. When a lot of people want redemptions, they want their money out of the bank or in these funds. They want their money out because they feel nervous, or maybe their cost of living or their cost of capital or their businesses need capital back in. This is happening right now. We are in a recession, a slow-moving recession, not like 2008 that it's almost like we dropped off a cliff and everything just bottomed out fast. We are moving slowly, but if you go back to what Hemingway said about going bankrupt, it happened slowly at first and then all at once. I think this recession that's been building for some time, with the Fed kicking the can down the road by manipulating the monetary and fiscal policies, are going to run out of gas. If not before the election, certainly after the election, which comes up in just a few months. If you're not already thinking about where your money is invested, how you're going to invest your money, because you have to do something. You can't just put all your money under the mattress where it would be safe from harm, because even there, it's losing purchasing power every day. So where do you put it? The old models, meaning the models that we've used just in the last number of years, are outdated. Equity investing is very risky right now, unless you have inside access to something that's very novel. Very risky right now. These funds that did so well for a number of years, investing in equities, stock market and real estate, the tide's turning. And if you're still positioned there with your money, your hard-earned money, your 401k money, your taxable money, because you've put money there and you've taken the ride, I would think about, and this is not me giving you financial advice, this is my own experience, but I would think about taking money out and putting it on higher ground, more liquidity. This is what I call just leveling the playing field. You can't time the market exactly. No one can. But you can read the writing on the wall, the canary in the coal mine. And this is why I'm bringing this to you. This is a canary in the coal mine. The whole dam is not broken yet, but I think it's coming. So what do? Well, if you can get money out of some of these funds, and this is going to hurt the operators, I know it, but might be a good time to do it if you can. Many of them are gating their funds. This is what Starwood had to do. When people wanted their money out, they had to say, we can't give it to you now, or we can only give you small amounts over time. And that further causes alarm, because now new money is not going to come in. If the reports are out there, like this fund is having trouble, as many are having trouble right now, it's not just Starwood, then who wants to put money in that fund? Sounds risky to me. So that's why their fundraising has gone from 600 million per month down to 15. They're out of money. What are their options? In the article, it spells it out. Well, potentially they could borrow more money. They have a line of credit, but even their line of credit has been diminished. I think it went down from some number. They had original size of $1.5 billion in their line of credit with Starwood. It's down to $275 million. So it's down fivefold. So they only have so much more they can borrow to keep things going, to keep liquidity in the fund, because you've got to have some liquidity, got to have some margin. Every business has to have it. So they could potentially borrow some more, but I think potentially that's kicking the can down the road. Now, what some people are thinking, they're hoping that the Federal Reserve cuts interest rates later this year. I don't think that's going to make a difference at all. I don't know that they will. And if they do, they're not going to drop interest rates much. It's going to be a small amount, 25, maybe at the outside, 50 basis points before the end of this year. When we've gone up 500 basis points, that's 10%, not going to factor in. So I don't think that's an answer. They could sell assets. Well, what's the problem there? Everybody's trying to sell assets right now to regain liquidity. That's what starts bringing down the market values. That's what's going to happen across the board. It's going to happen in the stock market. It's happening in real estate. These values are going to come down. So to sell off, you're selling off at discounts. That's only going to deplete the fund more and reduce returns for investors tremendously, which is not the idea when you put money into the fund. Thirdly, they could just overall completely halt redemptions. And a number of funds I know about have completely paused and halted redemptions, even going back a year, 18 months ago. Well, again, I understand that the managers have to do that to try to preserve the fund and try to get through this gap period so that on the back end, they can bring, sell, refinance at the right time. That could be 2, 3, 4, 5 years out if they can manage through it. If they have to give their investors their money back, which investors would love to have it back, they're only going to be able to give back small portions or discount. So you can see everything's in a hard place, between a rock and a hard place right now. And putting your faith in the Federal Reserve to save the day one more time, I think is a fallacy, because the Federal Reserve's out of gas. Well, we're in an election year, and if the Federal Reserve lowers interest rates, that puts fuel back in the inflation pipeline. And inflation is running hot. They thought it was going to be transitory. They thought they could bring inflation down with raising interest rates. Hasn't happened. There's too many variables. I could spend another 2 hours talking about the variables. I'm just letting you know, as an investor, this is a time where you have to be focused and gain knowledge about the dynamics of the markets wherever you invest, whether you're in the stock market, in equities there, whether you're in real estate, combination thereof. You need to understand what to do. There are places to go with your money outside of even treasuries or cash or money markets. That's wise to have some there, but you've got to keep your money invested somewhere. Equities, not a fan, but that's what everybody knows. That's what you probably know. That's what you run with. That's the people you run with. I would move my money to other asset classes and other parts of the capital stack. That's trainings I've done in other places. Probably doesn't mean a lot to many of you, but there's shifts you can make. You have to have knowledge. You have to have access. You need to be with people who understand this, and it's well worth it for you that have relatively high net worth that you worked hard for all these years. Don't let it crater in the oncoming recession. It's a time where you've got to rise up and take control and take responsibility for your finances. You work hard to make the money. Don't let it go to outside elements that you don't control. You can keep control on your capital and understand how that you can actually take the opportunities that are coming. In the chaos, there's always opportunities. And this is a time when you can actually multiply your net worth, but you've got to know what you're doing. You've got to be connected. You've got to be placed with people who have done this, have access points, and you can ride coattail. This is not going out to the internet and searching for new real estate investments. That's the worst place you can be. You've got to have connection, network, relationships are everything. That's it for me today. I hope this has been helpful to you. Just remember, it's your responsibility. You've got to take charge of it. Don't let the markets control your destiny.